Hello, welcome to this Greenhouse Gas Accounting Basics video, where I'll be taking you through the foundational steps of accounting in the context of an organization's environmental impact and carbon footprint. To start off, let's define the STAR term, greenhouse gases. What are greenhouse gases? Greenhouse gases are gases that trap heat in the Earth's atmosphere and contribute to global warming. These include carbon dioxide, methane, and nitrous oxide, among a couple of others, and they are a result of burning fossil fuels, farming, and waste management, among other activities. Greenhouse gas emissions cause climate change, which can lead to more extreme weather conditions, droughts, and ocean acidification. Common sources of greenhouse gases here include energy use, which is the burning of fossil fuels such as gasoline and oil for energy, industrial processes, which includes the production of cement and steel and other chemicals, agriculture with activities like livestock farming and the use of nitrogen-based fertilizers, waste management in terms of landfills and waste treatment, and finally, transportation sources like air travel and shipping. In greenhouse gas accounting, and as is generally known, CO2e means carbon dioxide equivalent. To put it simply, CO2e is a measurement of the total greenhouse gases emitted, expressed in terms of the equivalent measurement of carbon dioxide, which makes up a significant portion of greenhouse gases. Next, let's talk about why we measure greenhouse gases. To avoid the worst effects of climate change, we need to restrict the increase in global temperature to no more than 1.5 degrees Celsius, and integrating climate actions into a business model will help companies meet their climate goals and make the business more resilient by acknowledging and mitigating climate-related financial risks. Just like financial accounting helps you to communicate the performance of a business in terms of profits, cash flow, assets, liabilities, and equity, sustainability reporting is the practice of communicating your business's broader environmental and social impacts to your stakeholders. It can help you improve your reputation, attract investors and customers, comply with regulations, and identify risks and opportunities. So, how do we begin the process of calculating an organization's carbon footprint? In greenhouse gas accounting, organizational boundaries refer to the specific parts of a company that are included when measuring and reporting its greenhouse gas emissions. Setting these boundaries is crucial because it determines which emissions the company is responsible for in reporting. There are two main ways of setting organizational boundaries. One is an equity share approach, where the company accounts for greenhouse gas emissions based on its share of equity in operations. If a company owns 50% of a joint venture, it reports 50% of the emissions from that venture. The second is the control approach, where the company reports 100% of the greenhouse gas emissions from operations it controls. This control can also be defined in two ways, with the first being financial control, where the company reports emissions from operations that it has the power to control financial and operating policies. The other type of control is operational control, with the company reporting emissions from operations where it has authority over operational policies and procedures. Later in the video, we're going to look at one entity as an example that happens to have operational control over its owned and leased assets like buildings and vehicles. For most businesses, without complicated organizational structures, operational control is appropriate. Next, you'll also have to set your operational boundaries. Operational boundaries are guidelines for firms in inventorying their greenhouse gas emissions, categorizing emissions into scopes. We do this to give companies a clear understanding of where direct and indirect emissions come from in their value chain, and they can then use this data to establish a greenhouse gas reduction strategy. As for how we do this, companies must analyze their entire value chain and classify emissions into one of three categories: Scope 1, 2, or 3. Let's dive into how we categorize emissions into one of these three scopes. A company often has over a dozen sources of greenhouse gases spread across their value chain, and it can get pretty messy. So how do we make our data more organized? Like I mentioned earlier, emissions are categorized under three scopes: Scope 1, 2, and Scope 3. Scope 1, called direct emissions, includes emissions that come directly from sources that an organization owns or controls. Think of emissions from burning fuel in company-owned vehicles or from factory processes. Scope 2, called indirect emissions and categorized by purchased energy, includes emissions from the electricity, heating, or cooling that an organization purchases. Although the organization doesn't produce these emissions directly, they result from the energy it consumes. Scope 3, often the biggest and most complex scope, encompasses all other indirect emissions across the organization's entire value chain, including everything from the emissions produced by suppliers, to the transportation of goods, to the emissions from the use of a company's products by consumers. Let's spend some more time on exploring each scope of emissions and how companies interact with them. We'll use a coffee shop as an example. Once again, Scope 1 emissions include any direct emissions from operations. If our coffee shop, Soda Brew, uses natural gas for keeping their store warm and heating water to brew coffee, then the emissions from this on-site gas use would be classified as Scope 1. Let's say Soda Brew also happens to own a delivery van to transport the coffee beans, sugar, and milk over to the store from the supplier. These emissions from their owned vehicle would also be in Scope 1. And just to reiterate, Scope 2 emissions include indirect emissions from purchased energy. What does this mean for a coffee shop? Well, Soda Brew needs electricity to light their store and to power their espresso machines. The store is also located in a complex that uses district cooling. All of these sources will be categorized as Scope 2, since they are all versions of purchased energy. And finally, Scope 3, our most complex scope, encompasses Soda Brew's supply chain, transportation, waste footprint, and material sourcing. For example, a latte you could order here is made from coffee beans, milk, and sugar. The emissions from growing, processing, and transporting all of these ingredients, plus the supplies to make them, are all part of the store's supply chain. And who is making these lattes? Let's say some of your employees who live further away from the store drive to work every day, while some bike and some walk. No matter how your employees show up to work, the emissions from their commute there are also part of the store's value chain and Scope 3 emissions. Now let's say most of Soda Brew's market is made up of busy customers who take their latte to go. The emissions from the production, transportation, and disposal of the paper cups you serve your coffee in are also your Scope 3 emissions, along with the emissions from the decomposition of organic waste like coffee grounds and food waste in a landfill or from the incineration of waste. Basically, product packaging and waste disposal is also part of Soda Brew's Scope 3 emissions. Since so much is covered within this scope alone, Scope 3 also requires further categorization of indirect emissions into 15 subcategories shown on the screen here. Although Scope 3 is arguably the most complex scope of emissions, it also often represents a company's largest portion of their total carbon footprint, exceeding the combined impact of Scope 1 and Scope 2 emissions, which makes it one of the most important to understand. By addressing Scope 3 emissions, companies can significantly reduce their overall environmental impact, which is crucial for meeting global climate goals. First, let's take a look at a company's upstream influence through their sourcing and supply chain. By focusing on upstream Scope 3 emissions, companies can drive sustainable practices across their supply chains. For instance, if Soda Brew sources beans from a supplier that uses regenerative farming practices, the carbon footprint associated with producing these beans is reduced. This can influence suppliers to adopt more sustainable practices, such as encouraging sustainable agriculture like organic farming, reducing deforestation, and minimizing the use of synthetic fertilizers and pesticides. Or they could also opt for suppliers who use lower emission transportation methods, such as shipping via sea rather than air. Through strategic sourcing, companies can set standards for their suppliers, encouraging them to reduce emissions and improve their environmental performance. This not only lowers the company's Scope 3 emissions, but also drives industry-wide change. Now let's take a look at a company's downstream influence through their products and consumer behavior. Like I mentioned earlier, Scope 3 emissions also include those associated with the use and disposal of products. Companies can influence these emissions by creating products that are more energy efficient or have a longer lifespan, therefore reducing emissions during their use phase. They can also promote responsible consumption, encouraging customers to engage in more sustainable behaviors, such as using reusable cups or opting for plant-based milk alternatives, which generally has a lower carbon footprint. End-of-life management is also really important, encompassing initiatives like implementing take-back programs or designing products for easier recycling, reducing emissions associated with product disposal. By taking responsibility for the emissions generated by their products after they leave the company's control, businesses can foster more sustainable consumption patterns. Essentially, addressing Scope 3 emissions often requires innovative thinking and the adoption of circular economy principles, which focuses on designing out waste and keeping products and materials in use for as long as possible. Consumers, investors, and regulators are increasingly aware of the importance of Scope 3 emissions, and companies that proactively address these emissions are seen as leaders in sustainability, which can enhance their reputation, meet stakeholder expectations, and reduce risks associated with regulatory changes. So now that we've reviewed what each scope of emissions means in depth, how do we know whether to include something in our inventory or not? This is where the process of mapping comes in. After we've set our boundaries, we're going to determine which sources are in use at which sites. The end goal is to know all fuel and energy sources used at each location to create a data collection site. We're going to begin by listing all operational sites, offices, warehouses, factories, retail outlets, etc. For each location, identify all the fuel and energy sources in use. This includes gas for heating, electricity for lighting and machinery, refrigerants, and other relevant energy sources. The goal is to understand what is being used, where it's being used, and how much is being consumed. This comprehensive list begins the foundation for your data collection efforts. Again, the end goal of this step is to create a detailed map of all emission sources at each site. This map will guide you in setting up a data collection system that accurately reflects your greenhouse gas footprint. After you've identified all your sources of greenhouse gas emissions, you can begin collecting data. You'll need to collect data from a variety of sources, including invoices and expense sheets for fuel purchases, energy consumption, and other relevant expenditures, utility bills to gather information on electricity and gas and water usage, inventory databases to track the consumption of materials that contribute to emissions, such as refrigerants or raw materials, and waste management records to account for emissions associated with waste disposal. Typically, the data you collect will cover one fiscal year, providing a consistent basis for annual greenhouse gas reporting. Greenhouse gas accountants will work with different staff in the company to gather this data. For example, accountants to provide financial records and expense details, operations managers to give insights into daily energy use and process emissions, facility managers to provide details on building energy usage and maintenance activities, human resources to assist with data and employee commuting if relevant, and CEOs or sustainability officers to ensure that the process aligns with corporate sustainability goals and to gather high-level data that might influence strategic decisions. By working with these stakeholders, you'll gather the necessary data to form a comprehensive view of your organization's greenhouse gas emissions, ensuring that all significant sources are accounted for. Sometimes it may not be possible to obtain actual data for every emission source. When this happens, greenhouse gas accountants need to rely on estimates to fill in the gaps. Consider employee commuting, a common source of Scope 3 emissions. If detailed data on how each employee commutes in terms of mileage and mode of transport and fuel type isn't available, you might use a company-wide survey to estimate average commuting patterns. This survey could ask about the distance traveled, frequency, and mode of transportation. And with this information, you can estimate the total emissions from employees commuting by applying average emission factors based on the type of transportation used, like car, public transit, or bicycle. It's important to document and disclose when and where estimates are used in your greenhouse gas inventory. Transparency about these assumptions and methods behind these estimates is key to ensuring the credibility of your emissions reporting. After collecting and organizing your data, the next step is to finally calculate your emissions. This involves converting your data into greenhouse gas emissions using appropriate emissions factors. There are two emissions calculations methods, location-based and market-based. For this tutorial, we'll be focusing on using British Columbia's emission factors based on location, which means using the regional average emission factors of the grid mix. You may be wondering, why does location matter for calculating emissions? Well, in BC, for instance, the emission factors for electricity are low due to the province's reliance on hydropower, but another province's electricity production, like Alberta, may instead have a bigger reliance on natural gas as opposed to hydropower. In the actual calculation process of emissions, it's as simple as multiplying the data we collected earlier by the relevant emission factor. Let's walk through a case study together for a company called BrightSparks Tutoring Services. BrightSparks Tutoring Services is a tutoring firm that provides tutoring for elementary school, high school, and university students. A group of UBC graduates started the firm after they met while teaching in the PASS program at UBC. They have 10 full-time staff and 100 part-time student employees. The Vancouver office is in Westbrook Village near the UBC campus and uses BC hydroelectricity for lighting and other electricity needs and uses natural gas for heating. BrightSparks has two company vehicles that run on gasoline, both vans. Vehicles are used to bring students to the offices as servants to working parents. The office is fully digital and minimum waste is generated, and 2 full-time staff each attend 1 conference a year in New York City, traveling by plane. We have their data for fiscal year 2023, so let's take a look. First, we see the boundaries that have been set. We can see that the Greenhouse Gas Protocol corporate standard is being used as the accounting methodology, that we are using operational control for the organizational boundary, and below, we have listed the scopes of emissions and categories that are being considered. It's also mentioned that carbon dioxide equivalent is what makes up this greenhouse gas inventory, since there are 10 different primary greenhouse gases. Next, we see BrightSparks energy use, fuel consumption, and natural gas bills listed month by month in the appropriate metric. Since we're calculating their emissions for the year of 2023, we've also added up the total combining all months. There are tons of different software and platforms out there created to streamline greenhouse gas accounting. In fact, there are even emissions calculators built on Microsoft Excel spreadsheets, which is what we'll be using today for BrightSparks. So now that we've reviewed the activity data provided for the company's facilities, defined the organizational and operational boundaries, and highlighted the items included in the measurement of emissions, we're now ready to find the emission factors for each emission source. Usually, we can obtain the emission factors from the Emission Factors Catalog published by the BC government, which complements the BC Best Practices methodology for quantifying greenhouse gas emissions. But for this case, we already have them identified, as you can see here. After we've identified the emission factor associated with each emission source, calculating the total emissions measured in metric tons of carbon dioxide equivalent is as simple as multiplying the emission factor and emission source's activity level together. For example, let's take a look at Scope 3, where we've measured business travel by air, medium haul. BrightSparks employees have traveled 15,600 kilometers over the course of the fiscal year, and the emission factor for medium haul business air travel is this number, as you can see. This means that 15,600 times this number gives us 1.27 metric tons of carbon dioxide equivalent. And this means that BrightSparks business air travel has caused the equivalent of 1.27 metric tons of carbon dioxide to be emitted. For this calculation, you can see that all we've done on our spreadsheet is use the multiplication function on the 2 relevant cells. After you've done this process for all categories, all you have to do is add up the metric tons of emissions to get the company's final total emissions. I mentioned earlier that there is a variety of different software and platforms created for greenhouse gas accounting besides Microsoft Excel. Let's take a look at one of them. Carbon Zero, an advisory service and carbon offsetting solutions firm, features a carbon footprint calculator that is easy to navigate. Let's perform the same calculation we did on Excel here. We can see that there is a section to enter flight data, and when we expand it, the calculator asks us to fill in our flight origin and destination data. We know that Bright Sparks is based in Vancouver, and so we can fill in the place of origin as the Vancouver International Airport. Bright Sparks employees attend a conference in New York, so let's go ahead and fill that in as our destination. We know that it's a round trip since the employees need to return from the conference, and I'm going to assume that they traveled in economy class for this case, although this is something you should clarify with other clients. When we click Calculate Emissions, the calculator conveniently and similarly gives us the metric tons of carbon dioxide equivalent emitted from this activity. You can see that we actually don't need the distance traveled in kilometers for this calculation, which is why, depending on the type of data you have access to and how quantitative it is, different accounting software may be more helpful. Now let's take a look at Bright Sparks Scope 1 and 2. Scope 1 includes stationary and mobile combustion. Let's start off with stationary. This translates to emissions from their facility's heating system, so we can go ahead and fill out 4,450 cubic meters of space under the office heating category, heated using natural gas. Next, let's log the mobile combustion, which also means the gas vehicle emissions. Now all that's left is Scope 2, which can be logged under electricity. When we've calculated all the emissions and added them all together, you can see that 27.03 metric tons of carbon dioxide equivalent is our final answer. Why might this number be slightly different from the total footprint on our Excel spreadsheet? There are a number of factors that could influence this. For example, carbon calculators might round numbers in a way that impacts the final total. Excel spreadsheets can have more flexibility in terms of decimal precision, which could lead to different totals. Carbon calculators might also use slightly different methodologies or emission factors based on the range that they cover. But the important thing is that we have two numbers that look really similar. And that's all there is to identifying the emissions profile of a company. So let's quickly review the steps to calculating greenhouse gas emissions. First, we reviewed the activity data provided for each of the company's facilities. Then, we defined the organizational and operational boundaries, otherwise known as the 3 scopes of emissions. Next, we highlighted items included in the measurement of emissions for this entity, and if something doesn't end up in your inventory, you should explain why these certain items were excluded. Afterwards, we find the emission factors for each emission source, and then input the activity data for each of the company's facilities. This can be spend-based or activity-based. Next, organize the activity data by category of emission source and compute the carbon dioxide equivalent emissions for each category. And finally, review, analyze, and summarize your results for reporting. So besides all of the numbers, what other purpose does a report serve? Along with validating and reporting your final numbers, a sustainability or impact report can include recommendations made by your team. For example, in the case with Bright Sparks tutoring service, we know that they commonly use 2 gas-powered vans to transport students to their office as a service for working parents. An easy recommendation here could be upgrading their vans to electric vehicles, which would significantly reduce transport-related emissions by eliminating the use of fossil fuels. Or, in the case of Solder Brew, a recommendation to decrease emissions associated with employee commuting could be to subsidize public transit passes in order to encourage the use of public transportation instead of driving to work. In any case, coming up with these recommendations requires a strong understanding of your entity's product or service, supply chain, and mission in order to create actionable and tangible recommendations that can effectively decarbonize the organization. Thanks for watching!